Having any customer that's greater than maybe 15% starts to raise some flags. That is going to affect the eventual multiple that they give the business. Other things that we look for are recurring revenue. How much of that revenue is really recurring and predictable? Are there barriers to entry? Does the company have steady year-on-year growth? A lot of buyers are looking at companies with a sort of scorecard, maybe not an actual scorecard, but some version of that. And that is going to affect the eventual multiple that they give the business. We really want to minimize the dependency on an owner. So having that second layer of management is really important. Because the business was so dependent on them, it was really limiting valuation.
Hello, everyone. Welcome to another episode of This Is M&A. My next guest is Lindsey Wendler, Managing Director at 414 Capital. She spent her career advising middle market companies on M&A transactions, capital raising, restructuring projects, with experience across industries from industrial to consumer to business services and fintech. Before joining 414 Capital, Lindsey held multiple managing director roles at leading investment banks, where she built a reputation for guiding lower middle market companies through complex transactions. She's also a certified M&A advisor and a certified business appraiser, giving her a very unique lens on what really drives value in a deal. Beyond banking, Lindsey has been on both sides of the table. She's even started her own business abroad and raised capital in Geneva, Switzerland. She's also deeply involved in the deal-making community, serving as vice chair and incoming president of the Alliance of M&A Advisors and on the board of her local ACG chapter. In her spare time, can you believe it? She has some spare time here. She once climbed the Himalayan peak with a small team, becoming the first ever to summit it and earning the right to name it Kaya Rain. With that, everyone, please meet my guest, Lindsey Wendler.
Hi, Steve. Thank you so much for having me. That was quite the intro.
Yes, you stay very busy. I see you all over LinkedIn. You're a busy person. So kudos to you for being able to keep at it.
Absolutely. I love what I do and try to stay busy.
I know you and I actually connected in person for the first time at AM&AA. I believe it was the summer conference last year, and we chatted about having this discussion. So happy to have you.
That's right. No, I'm really happy to be here.
Definitely. So why don't we just jump in? So today, what we're going to do is we're going to touch on a very critical question for every CEO and entrepreneur. What really drives value in a business sale? What we're going to do is we're going to break this basically down into three areas that a seller should understand. One, which is the hidden value drivers and what buyers care about. We're going to talk about why financial readiness pays dividends, and then the overlooked details that can quietly kill a deal, because we know some deals do go south. We have a ton to uncover here. So, Lindsey, I think we should just jump in. Where would you prefer us to kick things off at?
Maybe we should kick things off with what are the most common value drivers that will kind of set the foundation for what we're going to talk about.
Perfect. Let's do that. So, I just imagine you're likely going to talk about things outside of revenue and EBITDA, which is what most CEOs think are the main drivers, right?
Yes, absolutely. We love revenue and EBITDA, don't get me wrong, but other things that we look for are recurring revenue. How much of that revenue is really recurring and predictable? That goes a long way in valuation. Are there barriers to entry? Does the company have steady year-on-year growth? Is there a good narrative there to show that the company is on, a good trajectory? Is there a strong management team? Is there a management team in place for when a new investor comes in and maybe the current ownership departs? We really want to minimize the dependency on an owner. So having that second layer of management is really important. Even products and services that are resistant to technology change, we have a lot of that happening right now, and it's, I think, fairly unpredictable how AI will affect, even your and my job going forward. But as an example, one time I worked with a company, or I didn't end up working with them, but I met with a company, a prospect, this was probably 10 years ago, but they converted VHS to DVD. Well, we could already see the writing was on the wall. It was a pretty sizable company at the time, but cloud storage was already a thing, streaming was already a thing. That's an example of a product that was not resistant to technology change. And then investors want to know that there are identifiable growth strategies, that there's room to grow, whether that's organically or inorganically. And then while we want EBITDA, we also want strong EBITDA margins.
Is there a preference generally, organic or non-organic growth?
Really depends on the investor. Some investors really like buy and build strategies. So they look for fragmented markets where they can really buy and build and grow through inorganic acquisition.
Got it. Okay. And these value drivers that you kind of outlined, do those value drivers start to shift based on where you're at as a company? Like, a startup, very small, probably doesn't have a full C-suite, right? Versus a more mature company, or is it expected across the all layers of stages of a company?
No, you bet. Companies are at different stages and they're going to have different value drivers that are high and some are lower. And if they were all high, they would be larger companies, right? So I tend to work in the lower middle market. I'm typically working with companies that are 20 to 200 million in revenue. And naturally, companies that fall into this size are not going to have all the value drivers at full speed. There are going to be a couple where there is room for improvement. And I think investors really look for the value drivers where they can add the most value.
Right, right. And so when you were talking about these value drivers, what happens if a company is lacking in some of those areas? Is it just they're kind of going through their scorecard and they're kind of just dinging you each step of the way, and it's like yeah, half a point less here, half a point less there? Like, what's that look like in real world application?
Yeah, in a way, a lot of buyers are looking at companies with a sort of scorecard, maybe not an actual scorecard, but some version of that. And that is going to affect the eventual multiple that they give the business. They can look at comps to see where companies have traded and what the revenue and EBITDA of those companies has been to kind of have a ballpark idea of how a certain company might compare to others that have traded. And then based on some of these value drivers, they may raise or lower their multiple.
Hmm. Okay, makes sense.
I have a set of value drivers that I wanted to make sure that I could get through, um, because I think they're important for setting the foundation for our conversation around value drivers, and I think we got through most of them, really. The last thing I'll make a point about, and you mentioned this earlier, is having strong accounting controls and reporting is extremely important and can literally make or break deals.
Yep. Yep. No, it makes a lot of sense. I've been in that spot before where, all the way down from what is the EBITDA adjustments that are made to non-recurring versus recurring, especially a lot of startups, what they'll do is they'll have like these professional services. They might be small, but they're factored into the recurring bucket. And you want to make sure you clean all of that stuff up, right?
Absolutely, and a lot of smaller companies might be on a cash basis. You wanna get those, um, financials converted to accrual before running a process. You really wanna have GAAP financials when you're going into a process. Those financials are a lot more reliable for investors, and most investors are going to be doing some pretty serious financial due diligence, and it can happen that certain things might come up that the selling company wasn't expecting after going through this financial due diligence, and that can really kill a deal because it can erode trust and weaken evaluation, and then the seller's expectations aren't met, and you end up not having a deal.
Right, right. Question for you on the dependencies, just from your experience, because I know you probably get involved sometimes early in deals, before a deal happens, should I say? Sometimes late, because I know some CEOs just wait to the last minute to jump in. But was there an example that you can give where you were able to fix a dependency maybe early on where that issue actually made a company more attractive? Or is there any one dependency that you can think of that you're constantly bumping up against? Any line of sight to any of those types of things?
Sure, I can give an example. So, I worked with a business, a distribution business, where the owners were really most of the business. They had a few employees, but they were really the core of the business, and they came to us when they had a buyer at the ready. So, they thought they were gonna do this transaction with this buyer, and they just wanted help, some assistance getting across the finish line. Well, it turned out that this was not going to be the buyer for them, but the owners still wanted to sell. But what they realized throughout running sort of a mini process was that because the business was so dependent on them, it was really limiting valuation at and even interest in the company. So we took a break and they started hiring. They hired probably 4 key people at the management level that really took a lot of the burden off of the owners and made for a much cleaner transition when they eventually did sell, and they did sell. It was a successful transaction, but it's an example of how difficult it can be to transact when a business is completely reliant on the owners.
Yeah. You see that often in the lower end of the market where there's so much dependency on the owner, the CEO. Um, their hands are involved in everything, right?
And it's
Oh,
natural. I mean, at a
yeah.
certain point in the business life cycle, the owner really does need to be involved in many, many things. But as you grow, the only way to truly grow are to get the right people in the right places.
Yeah. So let's shift gears for a second here. Let's talk about financial readiness. How does that play into all of this? What should people be thinking about in their business to get ready? Maybe if you can give line of sight to that.
Yeah, absolutely. So, kind of what we touched on earlier. First of all, if you're on a cash basis, let's get you over to accrual. Let's get your financials in GAAP standard. It would be helpful to go back 2 to 3 years and restate those financials so that we have a runway we can show buyers. Another thing that's really helpful is doing a quality of earnings report. And I know, Steve, you and I kind of talked about this previously, but a QV can really uh, maybe not boost valuation, but it can protect your valuation. And in a certain way, maybe boost the valuation to a certain extent, because when we go to market and we have done a sell side quality of earnings report and that's ready for buyers to review, there's a lot more trust in the numbers because a third party has put their stamp of approval on the numbers. A quality of earnings report, for those that don't know, is essentially an audit of a company's EBITDA.
Mhm. I think both of those outcomes are welcomed, right? Either protect my valuation or increase it. So I think a QOV makes a ton of sense. I've spoken to other bankers as well. It's becoming more and more popular to get those done even at smaller stages of a company versus before they were big and more middle market, upper market. So I think it's a must for sure.
I really encourage every client I work with to go through the quality of earnings analysis exercise. It brings a lot of things to light. It gets them organized and just makes for a much more controlled package that you can present buyers where there's a lot less surprises, and less surprises equals better valuation.
So I'm just going to liken it to getting a what is it a walkthrough on your house before you sell your house, right? Getting all of the reports in line, getting all your ducks in a row. This builds that trust and it gets people to do less hunting and pecking at your financials and everything else. If you have it kind of buttoned up, it just earns that trust right away, right?
You're exactly right. That's a really good analogy. If I'm buying a house and I have my inspection and I find a few things that are wrong with the house, what am I gonna do? I'm gonna renegotiate the deal. And that's exactly what happens in M&A as well.
Yeah. It's better to catch those things first, fix them, so that way you don't have to deal with them while you're actually in full swing of your process.
Another really important piece of getting a deal done is managing expectations. And it's managing expectations from all sides. But as a sell side advisor, really working with my client and helping them understand what they can expect from a process is the difference between getting a deal done and not getting a deal done. So that's a really important piece as well.
Do you run across a lot of CEOs that kind of underestimate how much sloppy bookkeeping and not having their numbers, just because they're like, "Hey, our numbers are headed in the right direction. They're good. That's enough." What that actually cost them in valuation.
Yeah, there's a lot of underestimation as to how having messy books and records can affect valuation. Aside from valuation, it can make it just impossible to do a deal. You really gotta be cleaned up to a point where everyone can agree that we're looking at the same thing and that the numbers are what we think they are. No one wants to transact on numbers that could change later.
Right. Well, and you're ultimately sending a signal early when people look at, because that's the first thing they're going to look at, right? I know, even in my own experience in M&A, in fundraising, et cetera, there's three things I'm typically asked for, right? It's 3-year historicals, 3 years going forward. But the short end of it is they're asking for financials. They want to know the numbers. And you're sending a signal early that says you're either going to be easy to do business with or you're going to be hard to do business with, right? Meaning, are you guys aligned and going to be easy to take on and work with to transition the business, et cetera, right? So
Yes,
it does
and
send that early signal.
doing doing the cleanup in advance of going to market and doing a quality of earnings report, it really signals to buyers that you are ready, you are invested, you want to get a deal done, and that goes a long way in a process as well.
What would you say are some of the biggest surprises that do come up in diligence when it's related to financials? I know you've hit on some of those already, right? The type of financials they're keeping track of, et cetera. But what are some of the bigger surprises that you've seen?
So, I've seen where there's an unexpected amount of revenue coming from a certain business line where that was maybe a little unexpected. Maybe it's a part of the business that has less recurring revenue, more contract related revenue that's valued differently by buyers typically. So I've seen that come up. I mean, the biggest issue I typically see when there is an issue is a disagreement on what EBITDA really was. And also, once you get under LOI and you're working with a buyer in due diligence, if the numbers are not trending the way the projections look, that can kill a deal. And that happens sometimes. Sometimes companies run into an issue, maybe they lose a customer and maybe the financials aren't tanking, but they're kind of bumping along or they might be down a little bit. That's really difficult to deal with in a transaction, or it can be difficult to deal with in a transaction without the right narrative.
Right. I know I've heard some stories myself, given I interact so much with PE firms and investment bankers, advisors, and folks. One of the stories I heard is, there was a CEO of a company where they thought they can take it all on themselves, run the company plus run a due diligence process. And what ended up happening was the due diligence process took all his attention and revenue started to slip. That hurt the deal. That hurt the valuation because now all of a sudden they got a decline in revenue because, deal doesn't just happen in a month. It happens in 3 to 6. So for 6 months, this guy's revenue has been flat or declining, right? Because they thought they could take over the M&A process and run it themselves. Um, I've also seen customer concentration, have a huge impact. I hear that all the time. It's like we get into the financials, we start to look where the revenue is coming from. You kind of hinted to it a little bit, saying, "Hey, maybe there's a part of the business where maybe it's not reoccurring, maybe it's a one-off deal, but there's also concentrated. It's like one big deal or just a few big deals, right?"
Absolutely. Customer concentration is a really big issue in M&A. So for sellers, having any customer that's greater than maybe 15% starts to raise some flags. So it's not insurmountable by any means, but it's something that really needs to be worked with. I had a client once in the telecom space. They were in the infrastructure side of telecom, and they did have, I want to say it was like 80 or 90% customer concentration. So to a certain extent, they were essentially a subsidiary of another company. Um, but w- we weren't sure that they would be transactable. And this was another situation where they came to us with a buyer and that buyer ended up not working out and they wanted to go to market. However, in this sector, having customer concentration was not totally unusual, and we were able to build a really strong story around the fact that they had, long-term agreements and really sticky customer, and that brought buyers to the table, and eventually there was one that, they ended up moving forward with.
Got it. Good example. What are some other, I guess, kind of just aside from the financial side of it, deal killers, right? What are some of those other deal killers that you've seen? Is there anything trending right now, right? That you're seeing more of?
Sure. So at the moment, just politically speaking, having your HR diligence in a line is really important. And by that, I mean making sure I-9s look really good. Companies that have E-Verify are looked at a little more favorably. It's not it's not a must, but when any buyer is going to do a is likely going to do an audit of the I-9s. And what I've discovered in a few processes lately is that filling out the I-9 paperwork is not obvious. It's kinda like doing your taxes, it seems, where you kinda need an expert to do it. So we've brought in HR experts who've helped some of our clients fill out the paperwork properly, make sure everything's tidied up, and that has been the difference between getting a deal done and not getting a deal done.
Yeah. I had an episode with Chrissy Green. I don't know if you've met her over at Steptoe. She actually focuses, I believe, on the tax side of things. And obviously the tax component, that could kill deals. That's one of those silent deal killers, right? Where, they're doing business, out of a particular state, but doing business with other states, they weren't paying taxes. That pops up at the end, and that really could cripple a deal or hurt the valuation because there's so much uncertainty there, right?
Absolutely. Sales tax is can be a big issue. There are other tax issues that can come up, really endless, but for example, the Affordable Care Act requires employers to offer health insurance, after you reach a certain threshold of employees. I believe it's 50 employees, and some small businesses have kind of teetered on the edge of that and gone over on some years and maybe were not advised properly as to the fact that they needed to do this. I've seen that happen in a few instances where we've just had to get everything realigned and in good shape.
Got it. Got it. Well, let's shift the gears again. Let's talk about you for a split second here. How did you get into this? Right? Like I know a little bit about your background, right? We talked about being an operator, but what made you go rather than the operator route? What made you go this route where you're helping clients sell their business, one of the most important transactions in their life, right?
Yeah. So I have a little bit of an unconventional background. I have a biology degree. I was pre-med in college. I started a business in the luxury goods sector and kind of traveled around the world doing that. But I grew up in valuation and M&A. My father has a valuation firm and an M&A transaction firm. And I grew up around deals and valuation. And that's kind of the reason I had the idea to start my own business in the first place at the time. And after I sold that business, I took some time off and then I decided I really wanted to help other entrepreneurs go through the process and really be educated and prepared and get the maximum valuation. Having been on the other side, I really empathize with business owners. So came back to America. I originally worked with my father and kind of grew a group that we merged with another group. And, I ended up exiting that and working for a couple other firms since then. But I kind of came through it naturally and in a lot of ways very unconventionally compared to the typical, like, economics finance route. And I love what I do. I love helping business owners go through this process. We joke about it a lot, but I'm more of a counselor than anything. This is the biggest transaction in a person's life, and it usually entails most of their net worth. And that brings up a lot of emotion. That brings up a lot of emotion around personal worth, in terms of dollars, but also just like the quality of their lives. And I think I do a good job of being there for these business owners and supporting them as they go through this transition.
Just you mentioned your dad and kind of growing up around deals. So I'm just going to throw it out there. Would you say your dad is one of your main mentors?
Oh, absolutely. Yeah. My dad is definitely one of my main mentors. He's still very active in valuation and does some deals as well. We talk shop all the time. In fact, at family dinners, they usually make us sit next to each other so that we don't disturb the whole table with deal talk. But
Right.
yes, he's absolutely one of my mentors.
And have you had the opportunity to thank him for where you're at today and what you're doing?
You know, I don't know that I've actually sat down and said a specific thank you. So, Dad, if you're watching, big thank you. No, I need to have a sit down conversation, and I'm really grateful to be at the place that I'm at now, and at the firm I'm at, and doing the kind of work I'm doing, and it really wouldn't have happened without him.
That's great. Well, you've had the opportunity now and happy to be part of it. This was great. I really have enjoyed our conversation. I wanted to just give you the floor for a second to tell us how can people get a hold of you? Why should people get a hold of you? Maybe if you could dig into that a little bit.
Absolutely, you're welcome to contact me if there is information posted. Otherwise, through LinkedIn. I'm very active on LinkedIn, but LinkedIn or email is the best way to get in touch with me.
Definitely. And we will definitely post the information for folks to get in touch with you. It's funny, when you and I first met, again, going back to the M&A event, I had sat down with you at a dinner table and I was like, I feel like you and I already know each other. Because I'd follow you on LinkedIn. I interact with your posts. I find them very helpful. So I think they're very thought provoking as well. Yes, you are definitely very active on LinkedIn. It's good to see. Well, this is a wrap to our episode. I'm sure our listeners are going to enjoy the conversation. So thank you so much for being part of the show. There's so much we didn't unpack. These topics, you could probably spend countless hours talking through each one of them. But I would love to have you back on the podcast at some point where we could dive deeper on some more topics.
Would love to join you again. Thank you so much for having me.
Definitely. That's a wrap on another episode of This Is M&A. I look forward to seeing you all on the next episode. Until then, stay sharp and stay deal ready.
If this episode sharpened your thinking, share it, post your take, follow the show, or drop a quick review and bring it into your next deal. We'll be back with more real talk from people who've been in the room when it counted. The views and opinions expressed on This Is M&A are those of the guests and hosts and do not necessarily reflect the views of any company or organization mentioned. This podcast is for informational purposes only and should not be considered legal, financial, or investment advice. Always consult a qualified professional before making business decisions.